Even ahead of the interest rate decision, our next guest said that the Fed and the CPI inflation data were yesterday's news. Joining us right now is Mike Wilson. He's the Chief Investment Officer and Chief U.S. Equity Strategist for Morgan Stanley. And Mike, I guess you would say that today and tomorrow's news has to do around earnings.
That's right. I mean, look, the Fed and the CPI, I mean, that was the story in October. It's interesting, the price action, right? So in October, the downtick in CPI was a surprise. We got a big rally off of that because rates came in. But to think you're going to get another rally on that news, I think is, a bit naive because you already had it, right? You're going to get another rally on that. So I think what we can say about this week's data, CPI's peaked, inflation's peaked. We're pretty confident it's going to come down pretty hard next year. And the real question is, what does that mean about growth? And that's the second part of our bear market story that we've been talking about for almost 12 months now. The growth slowdown is not yet priced. And that's what's going to determine the winners. Like, it's a stock picking game. I mean, there are going to be some companies that deliver on that. But at the index level, we're pretty pessimistic that we can support these prices given our outlook on earnings next year.
I mean, pretty pessimistic is putting it lightly. Your consensus for S&P 500 earnings for 2023 is 16% below the consensus. That would mean a long way down, because usually it's a big deal if you move 2, 3, 4%.
That's right. We're not looking for a 5% miss. We're looking for 15 to 20% potentially. It could be that significant. Now, the good news, Becky, is that most investors agree. Okay, like the market, this is not new news. I mean, people assume earnings are going to come down, but it's the magnitude of that decline and how fast that's going to happen. We think that's where the surprise is, that the negative operating leverage that we see from falling inflation, by the way, is what's going to hurt margins, and that's irrespective of whether we have an economic recession.
There are some people who have said, yeah, we've heard this story before. We heard there was going to be an earnings recession. What has it been, 3 times now? And every quarter, the numbers have been pretty good. Why do you think that this is when the rubber really hits the road?
Yeah, this is always the trick. So I would say some companies are already in an earnings recession. So what we know is this year, every quarter has been disappointing, but we haven't yet gotten the guidance on 2023 because companies have no reason to talk about 2023 until we get there, right? They keep deferring that. But in January, they're going to have to address that. And that's why we think this is the quarter where you'll get a bigger step function lower on forecast for 23. And that will create the final, kind of plunge on multiples that can give us a real buying opportunity.
Mike, you have been pessimistic for a while, but not brutally pessimistic without any signs of life for things. There are moments where you've said, yeah, we're gonna see some gains, and we have recently.
Yeah.
You're just following the markets up and down based on where you think they should be for the numbers?
Yeah, well, that's our job, right? We're a bit of a fortune teller.
I know, but a lot of people don't do it. They have one opinion and they stick with it.
Yeah, we have to, we have to try and trade. When you get a 15% rally, you got to try and catch it. This one we got. Okay, we don't always get it right. We felt like the rates were going to come down, that the Fed is yesterday's news. I mean, this is now known. I mean, the bear market has been driven by Fed policy, higher rates, concerns about inflation, multiples have contracted. So we got relief on that, and that's why we rallied. But that's a trade because ultimately stocks will care about the earnings decline as much as they care about the Fed pausing or even continuing for another couple months.